On June 12, SpaceX went public, marking the largest IPO in human history. It raised $85.7 billion, and its market cap briefly hit $2.6 trillion, more than Coca-Cola, McDonald's, Disney, Nike, and Starbucks combined. But just 5 weeks later, the company had wiped out nearly $1 trillion in value. The stock fell below its IPO price, dropping in 9 out of 10 trading days. In 1 month, it went from the biggest IPO in history to the fastest evaporation in history. This was supposed to be a celebration. Instead, it turned into a question: if SpaceX is really worth $2.6 trillion, why couldn't it hold up for even 6 weeks? The mainstream explanation is simple. A rocket launch got scrubbed, investor sentiment turned sour. Sounds reasonable. But if you remember the video we made a few months ago, Nasdaq quietly rewrote 3 rules just to fast-track SpaceX into the index. The waiting period got cut from 3 months to 15 trading days. The minimum free float requirement got scrapped entirely. And the float weighting got artificially tripled. We said one thing back then: manufactured demand eventually comes due. Now, it's time to pay up. Let's rewind quickly to why this was off from the start. First, the business itself is losing money. SpaceX is really 3 businesses stacked together. Starlink makes money, the rocket business makes money, but XAI, the company it acquired, burns through nearly $1 billion a month. SpaceX posted a net loss of $4.9 billion in 2025, and lost another $4.28 billion in the first quarter of 2026. Second, the valuation doesn't match the revenue. A $2.6 trillion valuation against just a few tens of billions in annual revenue is a multiple even crazier than OpenAI or Anthropic. Third, the demand was manufactured by design. Retail investors got a 30% allocation, triple what a normal IPO gives out. Passive index funds were forced to buy in because of the new rules. In other words, the buying wasn't the result of people studying the fundamentals and deciding to invest. It's because the rules were built so that you had to buy. This isn't the market pricing SpaceX. This is the system transfusing blood into SpaceX. We've seen this story before. Case 1, Rivian, 2021. The electric vehicle darling that hit a market cap on IPO day bigger than Ford and GM combined, even though it had only delivered a few hundred vehicles that year. 6 months later, the stock had lost more than 80% of its value. The market eventually admitted that was the price of a story, not the price of production. Case 2, WeWork. Valued at one point at $47 billion. Then the prospectus came out, investors realized the number couldn't hold, the IPO collapsed entirely, and 2 years later the company filed for bankruptcy. The market found out the truth late, but not too late. Case 3, Facebook, 2012. This one's a reminder that a rough start doesn't mean a company is doomed. Facebook stock got cut in half after its IPO, and it took a year before it actually proved itself. So the question was never whether the company is good or bad. It's whether the price on IPO day already borrowed against a future that hasn't happened yet. 3 cases, 3 different endings: zeroed out, bankrupt, and a comeback. But they all opened the same way. The IPO price had already priced in the most optimistic version of the future. Now let's apply that same logic back to SpaceX. In mid-July, seconds before a Starship launch, 4 Raptor engines failed to ignite and the system auto-aborted. This was the first real test flight since the IPO, and it's the exact same issue as before, since the May test flight also had engines cut out mid-flight. The stock dropped for 6 straight sessions out of 6, briefly falling below the IPO price, wiping out nearly $1 trillion from its peak. Meanwhile, short sellers have already built a position worth close to $25 billion. Analysts have issued neutral ratings, and the reasoning is blunt: valuation, and the upcoming lockup expiration. Translated into plain English, that means the shares early investors are holding will soon be legally free to sell. Retail investors and passive funds were the ones the rules ushered in as the buyers, while the people who actually know what's under the hood are waiting for the right window to exit. This is the same idea we've talked about before. The people who understand it sell the stock to the people who don't. Except this time, they don't even have to lift a finger to sell it. The index funds do it for them automatically. SpaceX isn't a bad company. Starlink is profitable, the rocket business is growing. But the price set on IPO day was never about what SpaceX is worth today. It was about what it would be worth if the next 10 years go perfectly. One failed engine ignition was enough to crack that perfect story. This isn't a bug. This is exactly what the system was built to do. The rules decide who's forced to buy in, and the price only decides who actually believes it. As for when the bubble finally pops, nobody has an exact stopwatch for that. But you now know where to look. Not whether the rocket launches successfully. Watch who's selling on the day the lockup expires. If you want to spot the next biggest ever turning into fastest ever before it happens, hit subscribe.